There is an economic indicator that has predicted every single recession for the past 60 years, and it is flashing red right now and has been for 38 of the last 40 months. But this time, it seems like everyone's ignoring it. And here's why I think that might be one of the biggest mistakes of 2025. My name is Ari Van Gemeren. I manage $150 million in real estate across the US West Coast, former Goldman Sachs advisor, worked in equity research at a very large money management firm here in not here, in the Bay Area. And what I'm seeing on the ground in our portfolio is giving me a lot of anecdotal evidence that not all is well with the economy. But before we dive into this, I want to dive into why the LEI indicator is such a significant and important metric. And just so we're clear, this video is a accompaniment of a Substack article that we released this morning called "Is a Crash Coming?", which is built for our premium subscribers to the channel. The premise of this is I wanted to look into a lot of the data and understand what is happening. Is a recession coming? And as with any market prognostication, this is an area rife with risk for me to actually opine on, but I want to do it anyways because I think the data is pretty alarming. So just quickly on what I'm seeing. So I manage 550 plus apartments across Seattle, Portland, the San Francisco Bay Area. And for months, I've been watching something that official data just was not capturing. Residents falling behind on rent. Property managers would call me daily. So-and-so lost their job. I hear a lot about shipping companies shutting down. A lot of businesses exposed to the import-export space have been shuttering. So-and-so can't make ends meet. These are people who work across the West Coast that are not professional economists, but they are people who are collecting real rent checks from real Americans. And they are starting to see stress everywhere. We are seeing it as well. And the bizarre thing is for the last year, the official data kept saying everything was great. Jobs reports were printing strong numbers. GDP growth was steady. Powell was saying the economy was resilient. But my gut was telling me something was off. So last month, the Bureau of Labor Statistics quietly, and I do mean quietly, although the news did pick up on it, which is great, revised job growth down by nearly 1 million jobs. 1 million. Suddenly, these anecdotes had government confirmation. We, the royal we, had been living in a statistical fantasy. Now, really quickly I researched this briefly, why the numbers are so off. There's a fascinating bit here that I don't think a lot of people know about the BLS statistics. A lot of their predicted numbers per month, and by the way, revisions are nothing new. They've been happening. It's just the million is a really massive revision change. But why does it happen? So you'd think this is a really clean cut flow of data up and down the pipe, but it's not. A lot of the BLS job numbers are actually driven by a model. They have a model that attempts to predict how many new private company businesses are created per month and how many new private company businesses are lost per month. And their model is built off a historical analysis of data to say on any given month, this is the number we expect that the private economy has created and how many they've lost, right? Because private employers don't always report these numbers directly. The model has been wrong. The model has been wrong in the direction of more job losses and less job creation in the private industry, privately run businesses, small mom and pop businesses, think of it like that, has been dramatically wrong, right? So there was an explanatory piece. I'll try to find it and link it in the article, but there's an explanatory piece, 6-7 months ago to say, what is up with these huge job revision reports? So that's alarming, right? If the model is that off and small businesses are cutting jobs and shuttering at a higher rate than the model predicts, that tells you not everything is well with the economy. So I want to tell you why I take the leading economic index so seriously. So back when I was an equity research analyst at Fisher Investments in the early 2010 range, Ken Fisher, who's the founder of the firm, would frequently reference the LEI in our research meetings. This was my preliminary education in leading versus lagging indicators. Many investors focus on lagging indicators, unemployment rate, GDP growth, corporate earnings. These tend to tell you where we've been, not where we're going. Leading indicators, such as building permits, fall because you don't start construction unless you expect future demand. Consumer expectations drop before people actually stop spending. Weekly hours get cut before layoffs happen. So the LEI is really interesting because it combines 10 of these forward-looking signals. It's not perfect, but it does give you that crucial 6 to 12 month head start. So what I learned at Fisher was this. By the time the lagging indicators confirm a recession, you are usually already deep in it, right? The LEI's job is to warn you before the damage shows up in the official data. And right now, this thing has been declining for 38 out of 40 months. That is not noise. That is a fairly clear pattern. Now, you can argue there's a lot of weird stuff going on that we don't know about, but that is a really clear pattern. So let's get technical about why it works so well. The conference board, they are the ones who actually calculate this index, take 10 components and weigh them based on how predictive they've been historically. So here's its track record. It peaked in late 2000, 9 months before the dot-com recession. It rolled over in mid-2007, a full year before the great financial crisis. It even actually predicted the sharp COVID downturn in early 2020. But what's happening now is unprecedented. The LEI has declined 38 out of the last 40 months. We have literally never seen this degree of sustained decline without a recession following. Never. The big movers right now dragging it down are consumer expectations are cratering. People feel worse about the future than they have since 2020. Building permits are falling. Construction companies see no demand coming. Average weekly hours in manufacturing keeps dropping. Companies are cutting hours before layoffs. Initial unemployment claims are trending higher. More people filing every week. Might I also add, I saw a post on this. Continued unemployment claims are trickling higher, which means it's not just the initial. It means that people lost their job and then they are unable to find a new job. Here's the thing that's critical. The stock market, the S&P 500, is one of the 10 components of the LEI, and it is the sole bright spot in this entire scene. Yes, the stock market is a leading indicator of a recession. Typically, the stock market will decline in advance of a recession. In this case, it's the only thing holding it up. And when stock prices are the only thing holding up your leading indicator, I think you're in trouble, right? Because eventually earnings have to justify stock prices. And if the other 9 components are screaming recession, where are those earnings going to come from? And this creates what I would call the final act problem. Stocks are always the last to fall because they're forward-looking and optimistic. But when reality finally hits earnings, they will fall the hardest. And I have some terrifying graphs I'll show you later about the stock market. So you know what this reminds me of? December 2006 to October 2007. The exact same pattern in many ways we're seeing today, but everyone lived through it. The leading economic index had been declining for months. Building permits were falling, consumer confidence was cracking, manufacturing was weakening, but Wall Street kept saying everything was fine. Of course they do, by the way. Wall Street, in my humble opinion, will never call a bear market because they are reliant on business continuing as usual and continuing to clip money off of investor portfolios. They are not going to call a bear and sell everything. They just won't do it. Ben Bernanke famously said in March 2007 that subprime mortgage problems were contained and wouldn't spread to the broader economy. CNBC was talking about the Goldilocks economy, not too hot, not too cold, just right. The stock market kept hitting new highs. But what was actually happening underneath? As you guys know, credit markets were slowly seizing up. Bear Stearns hedge funds collapsed in June 2007. Northern Rock needed a bailout in September, but these were dismissed as isolated incidences. Meanwhile, AAA rated mortgage securities, the safest investment on earth, were starting to fail. These were complex instruments that sophisticated investors at Goldman Sachs, Morgan Stanley, and Lehman Brothers all thought were bulletproof. The parallels are starting to be uncanny. Back then, it was AAA rated mortgage bonds hiding massive fraud and leverage. Today, it's AAA rated auto loans from companies like Tricolor Holdings that just collapsed overnight. By the way, the auto loan industry is the second largest loan pool in the states, other for mortgages, right? This is not a small thing. This is big. The pattern here is uncanny. When supposedly smart money misses this level of systemic risk, it is not isolated, it is everywhere. And just like then, or just like today, the stock market was the last domino to fall. The S&P 500 kept hitting new highs through October 2007, even as the LEI screamed recession and credit markets were fracturing. It wasn't until Bear Stearns collapsed in March 2008 that people finally realized the warning signs had been there for over a year. The LEI index had been trying to tell everyone the whole time. By then, it was too late to prepare. The recession was already underway. The only question was how bad it would get. So here's the lesson timeless lesson here. Markets can stay euphoric and happy and up longer than fundamentals can stay strong, but eventually gravity does win. And when it does, the correction is swift and merciless. So right now I see three massive red flags waving to remind me of this. First, consumer credit is breaking down. Credit card delinquencies just hit 4.17%, the highest since the financial crisis. But it's not just credit cards. Student loan defaults are over 10%, the worst in a decade. Americans are tapped out. I am seeing this, as I said, in my own buildings. Residents who've never missed payment suddenly asking for extensions, young professionals with good jobs falling behind because their student loan payments just restarted. This, to me, feels more systemic. Second of all, corporate defaults are spiking. Remember how in 2007, AAA rated mortgage bonds failed? Well, Tricolor Holdings, who I just mentioned, just collapsed despite having a AAA rating weeks ago. This was a subprime auto lender that sophisticated investors, JP Morgan, Apollo, Jefferies, others, all thought was bulletproof. Then there's First Brands Group, an auto parts supplier that may have accumulated $10 billion in off-balance sheet financing. Now their junior debt is trading at cents on the dollar. These are seriously concerning issues. And thirdly, the stock market, in my opinion, is in denial. The S&P, okay, listen, this is an astonishing statistic. The S&P 500 is trading at 21 times forward earnings. Look at this metric. The Shiller CAPE ratio, which smooths out cyclical fluctuation, is at 33. We have only seen levels this high 3 times in history: 1929, 2000, and 2021. How did those end? 1929 led to the Great Depression. 2000 gave us a 40% drawdown of recession, and 2021 led to the worst bond market in history. And here is what is, like I've said before, is very alarming. The stock market is one of the major components of the LEI. When this thing turns, it's going to get rough. Let's talk about unemployment, because every recession in modern history gets confirmed by job losses. The unemployment rate ticked up to 4.3% in August. Here's the thing about unemployment. It moves slowly, then all at once. We're right at the edge of what's called the Sam rule threshold, which triggers when unemployment rises half a point off its trough. More importantly, as referenced earlier, job creation has also slowed to a crawl. August showed just 22,000 net new jobs, and previous months were revised down by hundreds of thousands. That is a massive shift, massive, from the 200,000 monthly averages we saw in 2023. Recent college graduates are getting destroyed. The unemployment rate for new grads is higher than it was before the GFC. I know because I lived through it. I graduated from UC Davis in 2009 with a history degree, and nobody wanted to hire me except Fisher Investments. And thank the Lord they did. It was awesome. But youth unemployment today feels exactly like 2009, except this time we also have massive tech layoffs hitting white-collar workers. That is a toxic combination. And really quickly on the young graduates not getting jobs in our economy right now. I have heard a lot of chatter about, oh, it's AI, it's AI, it's AI. Maybe it's AI. Okay, maybe. Maybe the white collar layoffs are also AI. Maybe. I don't know. I'm not convinced. It feels like 2009 to me. Like it feels like being a young graduate unable to find a job. It might be AI. It might not. It might be because companies don't feel good about hiring right now, which is not good. It's not good, right? None of this is to say we are definitely headed for recession, right? Another Ken Fisherism. He would oftentimes refer to the stock market as the great humiliator. Its purpose is to humiliate supposed experts who have all these ideas on what's actually going to happen. And I totally ascribe to that notion. I don't really believe in market timing. I don't think anybody has a good crystal ball. This is just some of the data I'm looking at that has me concerned. Okay, I'm not saying it's going to crash. I'm not saying we're going into 2008 again. There are some systemically worrisome things happening in the economy, but never bet against the ingenuity and capitalist initiative of the West and our ability to save ourselves from the jaws of defeat. I don't know if I got the metaphor right, but you understand what I'm saying. So anyways, what do you do with this information, right? And I wanted to kind of go through, and again, I'm a real estate investor. I focus on real estate. I did do stock market for years. I was a stock market guy. I worked at Goldman Sachs. I was a stock market guy there. So I can talk fluently about the stock market, but my core business is real estate. So we're going to focus on the way that some major operators in history managed through and survived periods like this. How did the legends thrive during this time? So Sam Zell in the 1970s and 80s, when Volcker cranked rates at 20% plus, everyone was paralyzed, but Zell didn't flinch. He built liquidity during good times. His approach was surgical. Buy fundamentally sound properties, crushed by bad debt, negotiate with desperate banks, use fixed rate financing. So by 1985, he controlled one of America's largest commercial portfolios. His secret, he never tried to time the bottom. He didn't do it. He just kept buying when prices made sense. I just had a conversation with someone about this exact topic. Don't try to market time. Don't do it. Think of your investing approach as a dollar cost average approach. If the stock market goes down 20% and you buy and it goes down 20 more percent, yeah, you're not going to feel great about it. But guess what? You still bought it 20% down and eventually it goes up. So don't try to like time the perfect timing on the bottom if you're a long-term investor. Now, if you're a trader, I can't help you. I don't do trading. I don't believe in it. It's not my strategy. If you're a trader, enjoy, have fun. These periods are good for you. If you're a long-term investor, dollar cost average in. Don't try to time it too carefully. The other critical piece of this for real estate people in particular is this. Everybody knows you buy in 2010, 2009, 2010, 2011. They know, you know that. How do you get the liquidity to do it? That is the difficult part, right? That is the hard part of this business. Unless you are a billionaire family office with extensive amounts of capital to deploy and you're waiting for it, the rest of us have to figure out how to have the liquidity to deploy. Good banking relationships. You hope the lenders are lending. You hope that the opportunity is there for you to strike, but you have to have the courage to actually strike when the iron is hot. You got to have it, right? And a lot of us don't. A lot of us don't. The stock market goes down 20%. Are you buying? Are you going to buy? Or are you going to think, well, what if it goes down 20 more percent? I don't want to participate. Remember this. The other group I love to talk about, because my wife is Iranian, I think it's fascinating, is Persian families in Los Angeles, 1979 to 1982. So keep in mind what had just happened. The Shah had just been overthrown. The Ayatollah was in place. The Islamic theocracy had taken over. There was a sizable Jewish minority living in Iran, and they fled. They fled with whatever they could carry out, gold, jewelry, cash, whatever they could smuggle out. And when they arrived in Los Angeles, and this is a fascinating point for those of you that don't know, they arrived at the time when rates and inflation were taking off, right? So if you were an existing real estate owner in Los Angeles, you were getting crushed. You're crushed, right? Because you bought in a nice rate environment and rates had skyrocketed. So these buildings were selling pennies on the dollar. And the Iranian diaspora had the training and the culture to understand real estate, to really want to be involved in real estate. And so they just wanted to buy real estate. I actually had a client years ago who was a Middle Eastern guy in the Bay Area who told me when he moved to the States, he just bought real estate because that's what his father told him to do. And he just kept buying and buying and buying. Happened to all be in Santa Clara. Do you think he made a killing? He did. But it was not because he was a super sophisticated investor. He just wanted to own good property. The same thing with the Persian diaspora arriving. They arrived into a scene of devastation and they started buying. They went in when mortgage rates were at 16% plus. They bought good properties and they rode the interest rate wave down and they made a killing. The key thing, they bought, they participated, they were prepared, they were on top of it. The last gentleman I want to discuss is Barry Sternlicht, 2008 to 2010. While Lehman collapsed, Sternlicht raised $5.5 billion for his distressed fund. He bought hotels at 30% of replacement cost. His edge was that he understood hotel operations from building the W brand, so he could see through the chaos to find the value, right? So by 2011, his fund was up 30% plus, while others were still waiting for the all clear to get involved in the game. Now, I know the pushback on this is always, well, that's a nice story, Ari, but all these people had a lot of money to work with. Totally true. Totally true. Build your relationships now. Be ready. The opportunity is coming. Here is what we are doing right now. We are buying vintage brick buildings on the West Coast at 6.5% to 9% cap rates with fixed rate debt. Here's the thing about commercial real estate that's really intriguing right now. The stock market is at an all-time high. Please remember back to the Shiller CAPE index, I don't even call it Shiller CAPE index. Where are stocks valued right now? I had an investor ask me this question maybe a year ago, because a year ago, the S&P 500 was down. It was a year ago, maybe a year and a half, and real estate was still up. And he said to me, what's the deal? Real estate is pretty lagging. Think about the mechanics of real estate investing. Sellers don't have to sell, right? Buyers recognize the situation on the ground. So for a long time, you have this massive bid ask spread and nobody's playing, right? Nobody's playing. So that means that private real estate, the prices remain stubbornly high, even while more liquid assets like the stock market drop in value. So at that time, it was kind of a bad time to buy. This situation is totally reversed, right? We are seeing really good opportunities in real estate right now. I think real estate is in a bear market. I've been saying it for a year now. Real estate is in a bear market, which is the time to buy, in my humble opinion. We are also vertically integrating. That means we are bringing everything in house. We are clipping 200 to 300 basis points to net income without raising rent, just by driving down the cost of operations, because we are not looking at property management as a profit center. We are looking at it as a control center and a cost control center to drive better returns for investors. The playbook is quite simple. We buy from distressed sellers, bridge loan casualties, estate sales, and there's a number of family owners who are selling for whatever reason, estate planning, whatever the reason is, to get out. We are locking in 5 to 7 year fixed rate debt on these properties, and we are focusing on cash flow, not IRR fantasies. Could the market go down more? Yes, it could. Do I care? No, because we are looking at it from a dollar cost averaging standpoint, and it is down a lot right now. Here is why I don't think the strategy can lose. If the recession hits, I am buying from desperate sellers while competitors cannot get loans. And if it doesn't, then my 7% cap rate deal in growing cities continues to cash flow really well. If rates drop to 3%, my buildings increase dramatically in value. If they stay at 7%, 6 to 7%, I'm one of the few with locked positive leverage. The only way the strategy truly backfires is operating expenses continue to increase extraordinarily, which I don't think is going to happen, because we're seeing it in the construction business. General contractors for years got away with murder, in my humble opinion, charging exorbitant prices, not doing work, only wanting to take on specific kind of work. That has completely changed. I think wages and labor costs are going to come down. The other thing to consider with real estate, wages have risen quite a bit over the last 5 years. Rents have not. That means renters right now generally can afford more, barring the delinquent residents and other issues I talked about earlier, which means that over time, rents will start to increase as well, which is very bullish for real estate as an asset class. The only way, truly like the biggest way this would completely fall on its head, is if major companies that are in these markets fail, right? And these cities we invest in become the new Detroit, right? And I don't think Microsoft, Amazon, Intel, Nike, Adidas, I don't think any of them are going anywhere. So look, the leading economic index has never lied. It predicted 1970, 1973, 1980, 1991, 2001, 2008, and 2020. Every single recession for 60 years. The credit markets right now are flashing red. Unemployment is creeping up. Stock valuations are at historic extremes, while the underlying economy deteriorates. The main question is this: how will you position yourself for this? There are many defensive asset classes that are totally worthwhile and worth looking at. Gold is a good one. Real estate is a historically defensive asset class in this time. Listen, guys, the graves are ready. And just like Sam Zell, it is time to dance. If you want the full breakdown with all the charts and data I've mentioned, I've written a complete analysis. The link is in the description. And if you found this valuable, hit subscribe, because the next few months are going to be really interesting. And by the way, full humility, I could be totally wrong. This is just what the data is telling me. The recession signals appear to be here. The question is, what are you going to do about it? Think well, act wisely, build something timeless. Thanks for joining me today.